Hello, everybody. Welcome back to the channel. My channel's name is The Covered Collar. My name's Max. I talk about these high yield, mainly covered call ETFs, but we cover other things like closed-end funds, and we also cover option trading generally. Well, today's video is going to be about option trading generally, but we're going to also tie in these high yield ETFs. Now, remember, it's not financial advice. Consult a professional advisor for all your professional advising needs. All right, guys. Is everyone familiar with Matthew Tuttle? He's a portfolio manager and a founder that's been on the station 3 times now. And Matthew is he's the fund that he's probably most famous for is probably MSTK, which is a strategy-based high yield fund. He's also has BITK, which is a Bitcoin-based high yield fund. Well, he has a newsletter that comes out every day, and I almost never miss it. Today I almost missed it, but thank goodness Brad from my Discord told me to take a look at it, and I did. And boy, I was glad I did. This is a good newsletter, and it's about options, and it's about hedging for the coming bear market with options. And let's see what Matthew has to say. Now, remember, this is Matthew saying this, and not me. I'm not recommending that you guys do any of these trades, but some of these strategies may or may not work for you, or maybe some variation of it might work. Maybe you have your own hedging strategy that you like better than this. That's cool too. Put it in the comments. I love talking about hedging strategies. Okay, well, today's newsletter is called The Hedge Wall Street Won't Give You. Now, he's been doing this for 44 years, and he's a young guy. I think he's just a couple years younger than me, but old Matthew started trading in the 9th grade, or in the 8th grade. In the 8th and 9th grade, he started trading. The premise of this newsletter is a lot of kind of conventional wisdom you hear, in Matthew's opinion, isn't necessarily correct. And we're going to talk about that. If you've been feeling like the markets are unstable, I mean, of course you aren't imagining it. I know I've been feeling that way. We have the index hovering at all-time highs, but yet, a lot of my investments, especially my high yield ETFs have been doing poorly. Most investors think they're hedged because they own bonds or gold, and Matthew's taking issue with that. So let's see what he says here. The driver for a lot of these problems that have been going on lately is the AI disintermediation, and that's breaking business models. So of course that's hitting the high margin, high beta, that cash flow businesses that used to have predictable cash flows. We've been seeing a lot of kind of rolling corrections just in individual sectors. Like I say, the SPY is close to all-time highs and really hasn't got hit, but a lot of sectors like AI and Bitcoin and others have been hit pretty bad. Drawdowns are not rare, they're scheduled. According to Matthew, there's been 59 meaningful drawdowns over the past 100 years. You get a minor drawdown every couple of years. We had one last April. And then you get a major drawdown every 9 years. We had one in 2022, and then we also had one in 2020. Here's the part that Matthew's going to take issue with, and he's not the only portfolio manager. I've mentioned a guy out of Austin named Chris Cole that has a portfolio called the Dragon Portfolio that has an allocation similar strategies to this. Bonds have been great the past 30 or 40 years, but as a hedge, but that likely won't go on forever. Matthew says bonds are an additional bet, not a hedge. When inflation or stress hits, bonds drop with stocks. Look at 2022. Bonds did not hedge stocks at all. In fact, they made it worse. Matthew says that it's going to fail again in an inflationary regime. If your plan is bonds will save me, you don't have a hedge. You have a bedtime story. Good point, Matthew. All right. So the second lie is gold is the ultimate insurance. Now, guys like Peter Schiff and others will take issue with this, but gold is a regime trade. And the regime, it's a way to play currency debasement, which is a thing. And it might give you a shock absorber in a liquidity crisis, but it's more of a belief in gold than a real hedging type mathematical trade. Matthew's into the math type stuff, and so am I. In a liquidity scramble, investors will sell what they can, not what they want. Gold is not engineered to pay you when the floor drops out of it. We saw this whenever as Bitcoin has been crashing this fall, gold crashed along with it. And I wouldn't be surprised if part of that was people needing to cover losses or margin calls in gold and silver, which had one of the biggest down days I've ever seen in my life, when silver was down, what was it, 20% in one day. I mean, that was miserable. That was miserable. And I wonder how much of that was people that were losing liquidity from Bitcoin. And I also wonder, when the gold and silver hit, if investors also needed to sell Bitcoin or stocks, other things that they could. Whenever you have a margin call, you can't always sell what you want to sell. Sometimes you have to sell what you have or whatever's still up. The only real hedge is convexity. And that's why I was getting at with that Chris Cole in the Dragon portfolio. He has a 20% allocation in that portfolio just to straight long volatility. Long volatility is convex. So the definition of convexity is an instrument that gain exponentially as market fall. So, and convexity can happen the other direction too, but in this case, we're talking about downside convexity. So SPY puts do that, put spreads do that, and also VIX calls do that. These are the only assets fast enough to catch a crash. They always talk about whenever a crash happens, all correlations go into zero, meaning what I said in the other thing. People sell what they can. And lots of times they have to sell an asset, maybe even that's doing well, but just because they have to cover the asset that's doing bad. That's called all correlations go into one. The thing that doesn't, the correlation that will not go to one, is an allocation to long volatility. This makes is inversely correlated to the market. When the market air pockets, traditional assets are too slow. So you need mathematical leverage with your options. Most hedges fell because of time decay, honestly. And that's happened to me. I'm guessing that's happened to a lot of you guys. And time decay just doesn't hurt hedges. How many times if you bought a call and you're right about the direction, but it doesn't get there fast enough and your call still loses premium. Time decay is a real killer, as you guys all know. The cycle goes, you buy a hedge, then you stay calm, your hedge bleeds, and then it's killing your return. And lots of times people will cancel their hedge or take it off right before they, inevitably right before the market crashes, just because hedges are expensive. It happens all the time due to the bleed. The solution is to stop buying hedges, start financing them. Don't pay cash, pay with carry or capped upside. Be the casino, not the customer. The goal is positive carry, or at least a neutral cost, plus convexity. When we get into option strat here in a second, I'll show you my opinion of that and kind of how to do that. The casino doesn't buy insurance. It builds a system where it doesn't need to, because the house hedge is built in. You aren't hedging because you're bearish, according to Matthew. You're hedging just because you're long risk, as an offset to your long risk. Okay, so here's the first idea. Here's the first idea. Now we're going to get into option strat at the end of this. For those of you guys that aren't as into options, let's just go through this, and then if you want to, we can look into this. All right. So tactic number one is he's calling it a seatbelt. I call it a collar, but this is a pretty basic hedge. We talk about this all the time on the channel. And this trade is where you sell an upside call and buy a downside put. I'm not even only going to show you an option strat, how to do that. I'm also going to show you a situation where this might help. So definitely stick around to the end. Okay, the cost of this is not a financial cost. The way these trades are done, they make enough selling the call to offset the cost of the put. So there's no additional outlay. how you're actually paying for this is with your capped upside, because you sold a call. That's your actual risk, is that you're wrong and the stock keeps going up. So that's what you're on the hook for. But as far as having to come out of pocket for cash to put this on, the idea is not to do that. So, Matthew says it's a seatbelt. It restricts your movement slightly, but it prevents you from going through the windshield. All right. So that's idea number one. Idea number two is the put spread. Okay. And he's saying not a lottery, buy a specific downside band. And I'll show you how to do that. So in this instance, he's talking about try to cover yourself from down 5% to down 15%. Don't hedge Armageddon. Hedge the first leg down, because you can always put on another one. So of course the benefit of this is puts are the most expensive thing out there, and they have the biggest advantage to sellers, and that's why so many people like selling puts. But to hedge, if you want to buy a put, you're taking the other side of that huge negative edge. Well, you can help yourself finance the cost of the put by selling another put. And I'm going to show you how to do that. And we'll give you a situation where that might be a good one to look at. All right. So number three is the Seagull. Now this trade I really like. So on this trade, you're also selling calls to buy puts. So it's similar to a seatbelt. The Seatbelt Collar, you sell a call and buy a put. Very similar concept, but you're going to sell a call spread. So you don't have unlimited loss on the upside if the market goes against you, or if the market keeps going up. If you don't need the hedge, at least your cost on the upside isn't unlimited; it's capped. But by the same token, you buy put spreads on the downside, so you don't have just a naked put bleeds too much. So this is low cost crash insurance. It's defined risk on all sides. I'm obsessed with this trade. When ULTY first came out, or had been out a couple of months, we were looking at these trades, and they did this exact trade in Netflix, and I loved it. They sold a call spread to buy a put spread, and I thought that was the ULTY strategy. And for a while, I just absolutely loved it. And then I adopted this into what I call the three-leg risk reversal. But I copied it off this Seagull trade. This is an interesting trade, to say the least. It massively reduces your bleed compared to naked puts, but it still gives you the crash protection, in the 5 to 15 zone, the place that it goes every couple of years, a shallow crash, let's just call it. Okay, so tactic number 4, and this is the most advanced, and this reminds me of my friend SB and my friend Ambassador of Quan. They both trade in this style, and I know a lot of other people do too, but this is a more sophisticated hedge fund type trading. But in this trade, this isn't necessarily so much just one trade. This is a campaign. This is where you pick a stock you like, and you maybe get long through a deep in the money call, or maybe even a leap. So you're long the stock, but then maybe 6 months out or a year out. So you have 70 or 80% the upside of the stock through the long option. But then, of course, you're long an option, so that call's going to bleed. It won't bleed as much as puts, because usually puts are priced higher than calls, especially on indexes. But it will definitely still bleed. And oftentimes on individual stocks, calls are priced higher. And so lots of times, and I think the way SB and Ambassador of Quan generally do this strategy is with stocks, not, so that call is expensive, but you can support the call by selling shorter term premium against it. You can sell a strangle, you can sell a straddle, you can sell a put spread, and maybe you do that in the weekly time frame. Maybe your option cost, maybe your long option costs $20, and maybe you're able to sell $1 worth of premium every week. Okay. Well, after 20 weeks, in theory, your long option should be financed by the premium off the campaign, off the shorter shorter dated put spreads. The edge in this, and this is just a fancy way of saying it's a calendar trade or even a diagonal. But the idea is of this trade is the options that expire every week, even though they aren't as expensive, they decay at a faster rate than the option that expires 6 months or a year down the road. So you're just trying to take advantage of the difference in the decay rate. Matthew says, fund the hedge, don't become the hedge. And this, yeah, that one is very sophisticated. I need to have Ambassador of Quan or SB on my channel, and they can and maybe they can explain their strategy. This is a very, very interesting strategy. All right, so now tactic 5, and I talked about this the other day a little bit with Mike Coe, but this is just buying VIX calls. Now VIX is the volatility index. So the reason we're buying calls instead of puts, because when volatility goes up, the market goes down. So calls in volatility are a bearish bet on the market. Okay, but these calls are particularly overpriced, probably even more so than individual stocks and stuff. The VIX calls are notoriously overpriced. So Matthew says, never do naked calls, always buy a call spread. So you're selling a call that's further out of the money that helps you finance the call and it keeps you from bleeding to death. Now, it's kind of the similar concept to hedging with the put spreads in the 5 to 15 zone. Matthew says, don't light the money on fire waiting for the spike. Okay, so let's get in the middle of this. Okay, so the first trade, and I'm going to show it in Carvana. Now, the first trade is called a seatbelt. Now, I'm going to give you an instance where you might use a seatbelt. Say you've been in Carvana since 300. Say you bought it, a year ago or whatever. You've been in it since 200. It doesn't matter. You're in it at a lower price. You've written it up, but lately you've seen the leadership switching and and it hasn't been doing as well. And you'd like to preserve as much as you can of the profits you still have left. In addition to that, Carvana has earnings coming up after the bell tonight. Okay, so this might be the seatbelt trade might be a way to do this. So what you would do is you could go out of the money with the call. So say we're gonna sell we'll sell a 380 strike call. Well, it's bid at 1765. It's asked at 20. Hopefully we get around 19 for it. Okay, so we bring in $1,900, and then we buy, and we can vary how far out we buy. But we buy, let's say we buy a 345 put. Well, let's do a 342.5. Okay. So we could buy the 342.5 put, and that's our seatbelt trade. Now I'll save this and put it in the comments in case you guys want to play around with it. So we'll call this the Seatbelt Collar. Okay, so the idea of this, as you can see, is if the market goes up, you're going to be mad if they hit earnings and Carvana goes to $400. You're going to be mad. And in fact, this hedge is going to be a $1,900 loser at expiration. I mean, so it's going to actually, even though you took in an $87 credit, you're going to end up owing the difference between $87 and $1,900. You're going to end up owing like the difference. So that sucks, right? However, if Carvana goes down, you can see you're protected under the put strike. Well, the thing about this is, remember the scenario I gave you. You probably wouldn't want to go out and buy Carvana right now and put this trade on. I mean, I guess you could, but remember the scenario I gave you. What this is perfect for is in a stock that you have a built-in gain in. Maybe you don't want to give it back, especially to a bad earnings announcement, or you don't want to give it all back. So in the scenario I said we're long from 300. So essentially you're out at 342.50. I mean, you're hedged underneath that. So essentially you've locked in the difference between 300 and 342.50. And let me show you how that happens. So these two legs, this is just the overlay. To help visualize this better, you can put the shares in here. Okay, so with the shares plus this together is the total, is what will happen, what can happen to the total position. However, remember, we got the shares at 300, so we have to correct this price. Okay, so that's the situation you put yourself in. You've locked in a $4,337 gain. What did I say? You've locked in between 300 and 342.50. But of course, well, yeah. Well, anyway, you've locked in. It comes to 43.37. I was going to say you have to subtract the price of the debit, but this was actually for a credit, so you actually add the credit in. So you locked in 42.50. You add 87.50 to 42.50. There you have 43,375. So between now and the end of the week, this is the worst that can happen to you. If they hit earnings and go up big and you hold it till expiration, you can, your trade can be worth a total of $8,000. So, and that's because if it goes above the 380 strike, you're long at 300 and then you're short at 380 through this option. So your max profit is 80 points plus the credits you received, right? And there it is, 87.50. All right, so this is a good trade. It works great in something you already have a profit in, but that doesn't have to be the case. That certainly doesn't have to be the case. So I'm going to save it again so you can see it this way. So we'll overwrite the existing trade. Like I say, those will be in the comments. I would highly encourage everyone to go read Matthew's newsletter, not just today, but every day. But he goes in more in depth than I did. And there's other situations to use these. I just showed you, how to use them in Carvana when you had a built-in profit. You could also use this to hedge a high yield portfolio. Let's say you have a bunch of blocks and a bunch of Alt and a bunch of K yield and a bunch of high beta stuff like me. You can maybe do one of these strategies, every month and say the Qs or say even IBIT, Bitcoin, and use that as a partial offset to your long exposure in your high yield portfolio. Not financial advice. That's up to you. Not for me to say. If you have any question about how to do these in your own account, show up on my live stream and we can do a few more of these. If you have something you're looking to hedge, a different ticker, these may work better on some tickers than others. We can talk about that in the live stream today. Be there for the live stream today at 5 o'clock Eastern. All right, guys. Thank you very much. Have a great day.